Good morning, everybody. Uh, Today, on this webinar, we have Samyuktha, Roshan, and me, Harshil. And we are part of the Sphere team here at iThought. And we are very glad that we have completed 2 years today. And we thought that it's a great time for us to interact with all of you, uh, just to highlight what we have done and what we think about the entire industry and where we stand in the entire industry. So I'll take you through the first part of the entire webinar, and then I'll hand it over to Roshan and then Samyukta. So let's look at what uh, is the entire size of the market. What is the entire discretionary PMS industry looking like? So first, the entire industry is equity. About 93% of the entire discretionary PMS market is equity, and multi-asset happens to be just 3% of it. Right, the rest is debt and hybrid. So, in the entire scheme of things, all investors really want to go towards equity, with the idea that equity is the only product that is going to give them extremely high returns because they are taking higher risk. And multi-asset or debt or hybrid, they are not very efficient products. They don't really work for the investor. They don't really make any sort of impact for an investor as well. Right, that's usually what investors think about when it comes to multi-asset. Right, so that's why you see 93% of the entire discretionary PMS industry is more equity oriented, right? And these are all APMI data, which is Portfolio Managers of India data. So nothing is from our side. Right? Now let's look at multi-assets and where the money really is. Right? See, 48,000 crores is in mutual funds. Right? The entire size of the just the pure multi-asset funds happens to be just 48,000 crores. Non-discretionary, which is it's just execution only, which means the investor is the one taking the call. There is no fund manager involved. There is no process involved. There's nothing. You're just using the services of a portfolio manager to execute trades, right? To execute what you want to do. Right? And discretionary happens to be a very small part. It's just 10,400 crores. It's a very small part of the entire multi-asset space by itself, right? So it's still very small, and it has a lot of scope for growth, right? Because we are investing in products that are less efficient when it comes to mutual funds, where they have a particular cap to invest. Majority of their investments also are on the equity side. So their asset allocation happens to be 60% in equity, 20% in debt, and 20% in the rest, which is more global. There is gold, there is silver, right? So 60-20-20 is what their allocation is. And here on the sphere side, we don't have a particular cap on an asset class. We can go 0 to 100 in any asset class. So that you will see going forward as to what we are doing on each of these asset classes, right? But broadly, the industry is very small, right? Mutual funds happen to be most of the multi-asset industry. Even the multi-asset doesn't happen to be that big of a chunk when it comes to discretionary PMS, right? So where does sphere come in now? If you look at discretionary PMS as a whole, when it comes to multi-asset, that 10,500 crores, 10,600 crores, 60% of it is less than 100 crore AUM, right? Now, if you see on the left hand side, we have split up where the money really is. 60% of AUM share comes in from less than 100 crores as a market AUM, right? And those assets have generated somewhere around 6 to 8%. So if you see, even they are not able to yield as much as what an equity product really goes out, and that's where the biases come in that investors need to go towards equity. Sphere operates between the 100 to 500 crore range, where that happens to be just 6% of the entire discretionary multi-asset PMS industry, and that has a high yield of 12%. Right. So this is where Sphere is really operating, because our AUM right now is somewhere around 335 crores, 340 crores. So we are operating in this basket with most of the average returns coming in from this bucket. That 6% of AUM is generating somewhere around 12%. Now, if you see the rest, which is sorry, 28% is what is generating 12%. So if you see the rest, they are quite small. They are around 7%. So totally comes out to be about 12%. Even there, the yield is somewhere around 8 to 12%. So basically, what I'm trying to tell is that yes, the industry is quite small, and the yields that these uh, money is making is somewhere around 8 to 12%. That's what the average is, right? Anybody getting into the multi-asset space, be it a mutual fund or be it a PMS, their expectation usually is that yes, 8 to 12% is what we can do on a multi-asset PMS. Now, this is where Sphere comes in, right? Uh, where we don't have a particular cap on any asset class. We don't have uh, uh, any cap when it comes to debt. We don't have any cap when it comes to precious metals also. We can go 0 to 100 in anything. That's our mandate, right? And the only way where we can invest without any cap is to be thematic. So we are a thematic PMS. We have been doing thematic investments since our inception, and that has worked in our favor. And we'll take you through how it has worked in our favor, right? So this is how we are cutting edge. We are innovative. We are going the extra mile. When it comes to investing, we have a basket approach. We take concentrated basket approaches, which means we layer each and every investment as a basket. So, for example, when we take a call on a particular theme, let's say financialization is a great theme for India to invest in. For India as a country itself is becoming more financially inclusive. Right? So what we do is we are able to layer businesses on top of each other to make a proper basket. Now that can come direct in stocks, that can come as equity, that can come as ever. So we have the option to do all the three, whichever is the most efficient, whichever is the most uh, whichever comes in terms of high quality is what we are able to do, and we are able to do that with high concentration risk because we don't have a particular cap. So we don't have a particular cap that says we cannot go beyond 5% in one particular asset, we cannot go beyond 5% in one particular business, or we cannot go beyond 5% in one particular product, right? So we don't have any concentration risk, so we have been able to take concentration risk in the entire portfolio, right? And we are thematic in nature. The themes that we are currently playing have to be more towards infrastructure, are more towards financialization, and this is where majority of the portfolio is concentrated in. Right, so we are able to take advantage of all the growth that is coming in India without taking much risk by having a multi-asset approach. Now, Sphere is very investor centric, so we do offer customization through participation, which means that we are never going to run out of ideas. We don't really run out of ideas. We've built this product to scale, and that is where our appetite to scale comes in, which means that for our product, when new ideas do come in, you have the option to participate in them. We don't run a model portfolio. We don't run a model portfolio. Every portfolio is customized through participation. Any portfolio that comes in today is not the same as someone's who has come in 6 months back, right? Whatever opportunities are there today is what we are able to invest in, and that we are following across the board, be it this particular product or be it all the other products within our ecosystem, right? So any investors who is able to participate, who is willing to scale up, definitely has more options to participate in more themes and in turn make more money, right? uh, this is a product that is tailor made to fit all. It is not a product that is one size fit all, right? We do look at your financial goals. We do understand that there are certain goals for retirement, there are certain goals for wealth creation, and all our products are made through risk profile, and everything is tailor made. There's nothing where it is one size fit all, right? And most of our investments that we are able to do, we are able to buy on the cheaper side. We are only trying to look at winners. We are going ahead in terms of the market, and there we have put an example of how we have been ahead of the market in the further slides of the presentation. But we are future oriented. We only look to participate in winners of the future, and we don't follow any sort of trend that is coming in. There is no IPOs in this particular product. There is no momentum strategy in this particular product. It's pure fundamental, it's pure contra, it's pure value, right? This is how we are able to generate high alpha over an equity product as well. Now, I'll hand over the presentation to Roshan. Roshan, you can come in and take it forward.
Yes, thank you, Harshil. Yeah, thank you. So there are, two ways where asset managers generally go about the practices, right? One is just an easy way, right, where you, just buy what's standard, like what's been sold in the market and things like that. So the easy way that this is an example, right? Which we have followed before and we follow now as well. So the easy way for the example here is to have a play on gold, right? Which is just buying the standard gold ETF, which just follows the price of gold, which is still a good um, you know approach to take, but there is something extra that we can do right here, which is going the extra mile. So in addition to gold, we also bought the gold minor ETF and the silver ETF, which both act as complements, right? To give you that a bit of a better experience in the commodity space. So the level of research and the level of effort and the effort that goes in structuring the portfolio and managing allocations is what gives you that extra return. So that's going the extra mile, right? So here we have a few themes that we are playing or we have played already in this year, right? Before I start, I'll just explain the table, right? So there are two metrics here, which are your re-rating of multiples and your re-rating of earnings. So if you see plus, it's a positive re-rating. If you see minus, it's a negative re-rating. And if you see, equal, there was no re, right? So re-rating is basically the upward revision in the progress of the stock or the industry. So it's basically a revision in prospects, right? What you're expecting out of the particular asset. And this comes via the expansion of earnings or the expansion of PE multiples. So with that, I'll just go right ahead. We have a sizable position in the auto industry and the auto ancillary industry, which both total up to around 11% of our current portfolio, right? And the numbers that have come out this year have been great for the auto industry, especially in the premium segment. And this trend of premiumization is actually true across categories, where Indians these days are preferring to go for the more premium option rather than the cheapest option, right? So this is a sort of mindset change that's happening across industries and across sectors, right? So again, the Indian auto sector has a target to move to the third rank by 2030. And if you see a couple of months back during the festive season, October saw the highest ever sales in a month for PVs, which is your personal vehicles, right? Um, and again, PV sales also saw a milestone number of around 16% of year-over-year sales growth. This was again back in October, and your total sales across industry was 26 lakh units, right? And we believe that as the economy picks up and as we move towards that next stage of growth, this is a sector that's poised to do incredibly well. Moving on to infrastructure, we're extremely positive on this space as well, right? We have a 5.5% here, 5.5% of the portfolio. So India spending around, more than 100 lakh crores in infra from 2024 to 2030, right? And this is nearly double what we spent from 2017 to 2024, the last 7 years versus the next 7 years, right? And this also includes investments in green energy. So we are being a little bit value conscious here, and we're trying to allocate to the position as judiciously as we can. but we still believe that we will get more opportunities to increase the size of this position, and we are 100% ready to do that, right? So moving on to the global front, we have a 3% position in global tech, right? So at this point, we're cautiously optimistic, right, in terms of valuation. We've still not yet, fully completed this position. This position was started in the middle of 2023, right, and we're still um, building that position, and we are not in a rush to build this because we still see like ample scope for us to um, you know build this position over a period of time, right? And there is very good scope for us to build a pretty large position here, right? Over the next 6 months, we've not seen any, positive re-rating on this front as of yet, and that's not necessarily a bad thing because that gives us more than enough time, which we are prepared to take our time in building out this. So moving on to the public sector, right? Right now, our position is 5% on the non-bank side, right? Which includes your power, energy, things like that, your PSEs basically, right? This has done extremely well. We did also have a very, very, successful stint with the PSU banks, right? Which you will, see further like as we move on with the presentation in the latter part. So for PSU banks, we had more than a 10% size, which we fully exited earlier this year. So you'll see how we've done on that front later in the presentation. So going on to themes of 2024, these are a few important themes which we believe will drive our investing in the next year, right? So consumption is a very big part of our pipeline, which we have planned, right? So as we move back towards growth as a country, this theme is going to be a huge driver of getting to that next level, right? That we all aspire to go to. So India is said to be the third largest consumer market by 2027. And we've already seen a small hint of this in your PVs reaching record sales, right? And the sentiment of premiumization continues to trend across the board, right? Which again goes back to your everyday goods as well, right? So manufacturing and infrastructure are also two huge themes pushed by the government, right? And moving partially out of China is a huge talking point, right? Not only here, which we all know about, but even abroad. Like even if you see what presidential candidates are campaigning for in the US election, moving out of China is a huge part of their campaign as well. And we are very well poised to grab a slice of that cake. We have already grabbed a few slices of the cake. In the last 2 years, we've seen, deals being struck with global giants, your Apples, Googles, Amazon, right? Apple has opened up physical stores here. Foxconn is manufacturing iPhones here and exporting abroad. Amazon is building cloud infrastructure, and Google is investing around $10 billion in India as part of their digitization program for India, right? So coming here and exporting their products from here is a trend expected to continue, not only with these companies, but a lot more going forward. And going to the global side, our global portfolio will also continue to grow in 2024. We have a few spaces identified where we can start building incremental positions here as well. You can move on. So we've already, touched on infrastructure, auto, and global. So I'm just going to dive into the biggest pie of our portfolio, which is financial services, right? Um, this team is a huge part, is a huge part of Sphere, and this constitutes nearly 35% of the fund itself, right? So here we have everything necessary to financialize the economy, basically, right? And bring it to the next stage of growth. And our financial services portfolio include private banks, which we already have a sizable position in, and we are still, building that position, right? We have platforms, we have asset managers, and we have both life and non-life insurance companies. So if you look at insurance penetration in India, right, it's growing, but it's a far cry away from being at the stage where it needs to be. So to give you a sense, we're under 5% in terms of insurance penetration. And even if you look at a country like Taiwan, right, they have a penetration of nearly 15%. So there's huge legs for this 5% size to grow, right? And it's poised to grow massively over the next decade. And as the economy grows, the growth will be led by the financial services sector. So right now we are at a very nascent stage of a huge like a huge revolution in this space, and this is 100% a decadal theme, right? A theme that you can hold on and look forward to for the next decade. So with respect to fixed income, we do have a position in short-term fixed income, right? That's close to a 2% position, and we're still open to further investments in the fixed income space as well. And as we're seeing expectations of a rate cut increasing in 2024 in the latest monetary policy meeting, the markets have, you know, re-rated this part, right? And this is also a positive factor for the precious metal side, right? Where we hold a 9% position. So this is a purely defensive position, and this is also a space where we have been quite positive for a while now. And, we're seeing global giants, research houses, right, coming out with very positive, sort of commentary on the same. So now let's take a look at some numbers, right? These are a few valuation numbers that we have. So this is only for the equity part of the portfolio, naturally, right? We have a healthy ROE number, return on equity of 16.04, and the PE multiple right now stands at 31.04. So the fund's positioning is such that we invest in industry leaders, right? And that always comes at a premium. The price of leading businesses, the price of quality always comes at a premium, right? Although some of the major contributors of this number are currently not being bought, since their stock prices have moved outside of our comfort zone, right? But they're still being held. So that is also sort of a contributor to this, not cheap P, but we still believe that the price of leading businesses, right? That is the key part here. And after that, if you look at the beta, we have a very low beta of 0.55. This is basically a testament to our belief that you don't necessarily need to take outlier risk to achieve market beating returns. And you'll see the returns against some of our competitors later in the presentation. And this number will help you at that point to understand where we come from when we say that, right? The strategy is also very, very low on churn at 30% since inception. And for the last financial year, which was April 2022 to March 2023, the number was 29%, right? So this, again, backs our belief that we don't believe in short-term trading. We invest our ideas in a staggered way and hold them until the story plays out, right? So our our strategies create long-term wealth, and trading is something that is not a part of this philosophy and not compatible with this philosophy as well. So these numbers are again a testament to that. So when we look at drawdowns, right? So this is the largest drawdown we've seen in Sphere since inception, and this was back in June. So with our flexible mandate, our drawdown was 5% less than the Nifty during the during this period, right? And just 3% more than the static multi-asset index, right? So with this, I would like to hand over the presentation to Samyukta. She will take you through the rest of the presentation.
So I just wanted to talk a little bit about the success formula, right? So what is it that has actually made Sphere stand out? I think Harshil walked us through a lot on how Sphere is uniquely positioned within the multiverse, within the multi-asset PMS space, as well as multi-asset funds. So I and Roshan also walked us through what is the focus for 2024, what have we gotten right in the last couple of years, and for us, clearly the value plus contrarian investing framework is what has helped us manage both risks as well as returns. Because our risk management comes from focusing on valuations and picking out contrarian themes, but at the same time, only when we go against the tide or to do something different are we able to create that outlier kind of return. And this is not just talk. I'm going to actually walk you through our return numbers so that you know that from the industry average, what Harshil showed us was you're expecting anywhere between 8 to 12%, and that's the anchored sort of return expectation that people have when they come into multi-asset investing. Yeah. So first, in terms of fund positioning, I think our basic idea is that we do look at financialization as a big part of portfolio ideas. And there's a lot happening here, right? You have higher levels of financial inclusion. You have a cleaner banking system today than we did a few years ago. We have insurance that's picking up. You have a lot of things that are going to change in the way that markets perceive and deal with finances. And if you've been tracking other numbers like how people are saving, how many demat accounts have opened, all of this is just adding into that space. So clearly there is a shift from the informal to the formal, or from the unorganized to the organized sector. You're seeing a lot of transactions happening in a different manner. You're seeing a shift in the kind of financial products people are choosing to save in. So that's, I think, at the heart of where Sphere is. We also have and believe in working with market leaders. So Roshan explained how market leadership is such a key point of the Sphere framework, because you are willing to pay for quality, and that is going to show up maybe in higher prices, but we are very value conscious in that selection, and we are very strategic in how we make those and build those positions. But lastly, I think what we wanted to do with Sphere was to create a product that allows us to invest at all points in the market, that allows investors to participate continuously. So it doesn't matter whether the market is up, the market is down, or you're in a sideways trend. We're always looking at investment opportunities, and we believe in creating a framework that allows for all weather investing. And why is this actually important for an investor? I think when you're saving for a goal like retirement or anything which is long term, where you have 10, 15 years, you want to be able to save month on month, year on year, and you want to be able to do it in one place where you get exposure to multiple things. And it's a hassle free sort of investment journey. So, if we're able to position and create a product like that for an investor where they can continuously participate, where they can um, experience different asset classes, where they can go through market cycles with relative ease, right? With a lower beta of nearly 0.55, you're taking half the level of volatility risk as the index. So a much more stable journey with outlier performance. If that we can bring to the table for the investor, I think that is a good thing that we're able to deliver on. So where do we stand on risk, right? So I've talked about how the fund positioning is. I think firstly, we are neither too conservative nor are we too aggressive, right? We still, with multi-asset investing, I would say that we're somewhere between conservative and moderate in terms of risk management, because we are a little bit more aggressive in the position sizing, we are a little bit more aggressive in the themes, we do take contrarian calls. So it's not definitely a low risk product. But what are the return expectations that somebody can have when they're coming into this product, right? I think for us, anywhere between 5 to 7% over your average inflation is what we would try to anchor at. So let's say if inflation is around 5% today, you could expect between 10 to 12% as the return expectation. But what have we actually delivered? I think if you look at our 2-year number, we've been almost double of that at 20 to 24%. And we will go through our performance statistics as well. But the idea is not the past performance, right? It is about what can we deliver in the future. It is about how we are positioning both risk and return to protect you in markets that can be tough, and to also deliver in markets that can be friendly. Next slide, please. So just wanted to walk you through the performance numbers. So if we look at our absolute return on 2 years, it would be around 24%. The compounded return is about 21 or 22. On a 1-year basis, we've done 25%, and on a 6-month, it's been close to 20. And the last 1 month has been really good for multi-asset investing with 7.5%. So the yellow bars are basically Sphere's performance. The blue bars are generally your multi-asset fund, so like a mutual fund that has done multi-asset. And the green bars are essentially your flexi cap. So why is this important? Because one could argue that we are heavily allocated towards equity, say 75 to 80% of the portfolio, or 70 to 80% of the portfolio is in equity, and only the balance is in multi-asset. So if we look at 100% flexi cap portfolio, right, we are still able to outperform that category on average on a 2-year basis. So for an investor who wants both risk management and return management, I think Sphere is ticking that box for them. And just in terms of, again, if we look at how we performed versus the Nifty as well as our own benchmark, which is a multi-asset portfolio, there's a wide outperformance from inception till where we are today. And you can see this, right? So Sphere is the orange line. So you can see what that gap has been. It's getting wider. And I think we'll continue to operate in a space that gives you alpha over the benchmark, because we are being contrarian. We are looking at things that are different from the benchmark. We're trying to deliver a superior investment experience for people who are coming into the market today. I just want to walk you through one of the themes that we have played in the last couple of years. So, which is the PSU banks. This was a contrarian theme. A lot of people were not positive on public sector banks, primarily because you had this whole problem with your balance sheet running up till 2019. Then there was restructuring, there was a merger in the bank space. You had consolidation happening in the industry. The government had to recapitalize banks. There were a lot of bad loans. NPA numbers were high. And generally also, like, we all know what the perception on a public sector bank is, right? So given all of these things, there was enough of negativity which was being factored into these businesses as well as the pricing. And we felt that at some point, public sector banks were really cheap. And all of the reforms are actually going towards creating a positive story, which would probably take some time to play out. So our position sizing started right from inception. So we had almost 1.5 years of buying in this space. And as you can see, we had some opportunity to book profits in last year around this time, because essentially the public sector banks ran up And when you're in a contrarian theme, we have to be a little bit more proactive in adjusting our risk and return expectations. So we did a little bit of profit booking and position reduction in 2022. But after that, again, you came back to similar levels, say, in which we were buying. So we continue to scale up that position until about May or June this year, right? And from June to September, we had an exit opportunity. So between June and September, we completely exited this space. And after September, you've seen that there was a decline, and then there's been now a rally again in this space. But this is not what we would think is an entry point. Like the returns that had to be made from the contrarian theme right now have been made, and to start investing today would really not stick with our contrarian or value investing framework. And we feel that this has been a good uh, investment for investors, where we've been able to deliver alpha, where we've been able to position size gradually, and we've had a nice run of 2 years. Although this was something that we were looking at even prior to Sphere's inception. So largely our themes do take a few years to build, and that is the expectation we'd like to set as well. So now I just want to walk you through our delivery on returns as well. So our average return on Sphere has been about 13.6%, which is above what we saw as the since inception returns for multi-assets as a whole. Uh, in terms of standard deviation, that is how volatile has the portfolio been, was significantly lower than a pure equity index fund like the Nifty. And we are slightly higher than the multi-asset index that we are benchmarked against, right? But if we look at your Sharpe ratio, which is essentially a measure of your risk-adjusted return, we're very high on the Sharpe ratio. We're better than both a pure equity index like Nifty as well as a multi-asset investment like the NSE multi-asset index. And just to give you a flavor of our performance since last month end, which is November end. So our since inception return was about 21%. Our 1 year has been about 25%, outperforming the benchmark by almost 15%. 6 months have also been pretty strong, close to 20%. And our 1 month return was pretty fantastic for a multi-asset portfolio. To do 7.5% is not an easy feat. But we are not chasing month-on-month returns. We are not chasing the highest return. That's not the philosophy. That is the outcome of our actions, which is to follow a framework where we're managing both risk and return expectations, and to invest through all weather to allow investors to participate continuously in this product. Next slide, please. So Sphere works for you. That is the message for today. So you need to do what investors do, which is invest. And lastly, I just wanted to walk you through our team structure. So where do our strengths actually lie? I think the strengths are in research, knowledge, and process. And if we look at how our resources are split, we have more people on that side on research and strategy and fund management than we do on, say, marketing and sales. So this is just how our entire universe for the portfolio management services. We have three other products, which is Solitaire, our flagship multi-cap portfolio, True Blue, which is the truest or the bluest of blue chip portfolios, and Vriddhi, which is a growth-oriented strategy in small and mid caps. So I think with that, let's open up for questions. We'll be happy to address anything that's on your mind, anything that you want to ask us about, what we can do for investors, what we've done so far, outlook, anything. You could just type your questions in the chat box, or if you're joining from YouTube Live, then one of our teammates will post your questions here. I can see one hand up. Should be. Sir, could you please type your question into the chat box? So, contrarian investing basically means that uh, we are not following the trends in the market. So generally, there will be an idea that a certain theme or a certain sector is doing well, that there's a lot of positive news associated with that particular sector. Um, and generally the perceived level of risk in that space is much lower. So contrarian investing means that we look at ideas that are maybe not very popular today, where there is a certain level of safety in valuations because people are not rating those companies fairly. And that is how we pick ideas. So I had explained the public sector bank theme. So if you could just go back, do a quick internet search, look at articles of public sector bank relating to public sector banks in 2019, 2020, then you would get a flavor of what we mean by contrarian. Because the news surrounding a particular sector can be very negative. Uh, and sometimes there's a lot of validity in that negative reporting because there is actually some pain in that industry. However, there might be a point where the pessimism is too high, right? And people are missing all of the actual positive factors. Because what we felt, let's say, with public sector banks was that all of the reforms were actually helping the banks. Yes, there was a problem, but the problem was also being solved. And that is what we mean by contrarian investing. We don't follow the trend, we don't chase momentum. So, where there is already performance, we are unlikely to enter a theme when there is a strong consensus in the market, where everybody agrees that it's a good investment to make. Thank you, sir. I think we have one more hand up, so if you could also type your question, we'll be happy to address that. Investments are based on fundamentals only, in the sense that we follow a value investing framework, so that is fundamentally driven. We don't do trades, as is evidenced by our churn number also. So we are not in the process, in the habit of trading in and out of the portfolio. So we don't look at technical analysis. Mode of equity investment. So we do it through the portfolio management service itself. You would have to have a demat account open for that. Depending on where we are investing, it could be through, say, direct stocks, it could be through ETFs or mutual funds if we're taking a concentrated basket approach in that space. So, all right, let's read this question. The market is already high, and it's very obvious that the favorable valuations available are very few, given that one, what is the strategy of I thought going forward, as even if FIIs sell, it's complemented by Indian DIIs, retailers, etc., buying simultaneously, resulting in minimal or low no value drop. Is this going to be the new norm in the market where we will never see a scenario like often in the past where the market went down to 10 to 15% due to continuous inflow from Indian retailers? Will fund managers be pushed to a new style of investing like above reasonable valuations are fine to invest to due to the change in overall investing culture as there is no drop in any share value? Okay, so this is an interesting question. I think one is that we are noticing the trend that you highlighted, which is that whatever selling has happened from FIIs in the past has always created some instability within the market. I think now that you have matching flows from domestic side, you're not going to see those that kind of volatility because of flows. But given that there could always be volatility because flows are one of the drivers, sentiment can be another, and overall, if globally things get weaker or you're having some kind of change, you could still see the 10 to 15% dip, right? So if you look at markets overall, on average, on a yearly basis, you will have days where there are corrections, right? But nobody, or you'll have script specific corrections. I think one thing you need to understand is that there will always be an opportunity to buy, there will always be an opportunity to make returns. You just have to be more selective when the risk is higher. And I think that's exactly why we outsource this work to fund managers who are taking that call. We will continue to invest. I don't think you have to get out of your valuation comfort zone yet. We are not in that market where we are forced to buy expensive. And we are not of that philosophy also where we need to deploy money just because it has come in. So for new accounts, for instance, we may not deploy more than say 60% of the investments in the first month. We take time to do the portfolio construction primarily because we want to participate in the market at fair valuations and not get into something just because it's part of the portfolio. So that is what we were talking about in terms of customization as well. Wherever the investor is able to participate, we are able to add in a little bit of customization because at each point in time, the opportunities are different. Primarily because we want to stay true to our roots, which is in value investing and contrarian investing. We don't want to break those rules to make new investments or to just fulfill that requirement.
Just to add to that also, see for the third, I think for the third question, will the fund managers be pushed to a new style of investing like above reasonable valuation? See, if when we interact with the industry, when we interact with the fund managers in the industry, it's not that they are going to be pushed. It has already happened. Most conversations now are to do with growth at a reasonable price, right? So that is the kind of language that is moving around in the entire industry, where nobody wants to stay away from this market. Nobody wants to miss out on making returns in this market, because India is a very strong market compared to all the other emerging nations. Also, we are the only nation that's giving you 7%, right, from a GDP perspective. So flows are coming in from our side, and this narrative of growth at a reasonable price is already in the air. So and it's not a new style. It keeps going from one cycle to the other. The previous cycle, it was more to do with I will do more value investing, and now it is more growth at a reasonable price, and then again it would probably go. So it's not new. It in every cycle the language keeps changing.
And I think to take that last question in financial services, see, we are looking at the whole theme, right? And depending on valuation, we may be able to buy something more at a particular point in time than another. So I don't think we're going to look at, do we want to have more allocation to this or to that? It's again based on valuation and where we can allocate. Yes, our fee structure is pretty clear. It's 1.5% plus your GST and any transaction costs that you would have. It's a flat fee. We don't have any performance uh, metric. We wanted to create a product that is simple for investors, where we're transparent on the fee structure. It all the upside belongs to the investor. We don't take any portion of that. And we also don't have an exit load. So if there is a requirement for you to exit earlier than, say, your original investment horizon, there is no charge for you to do that. The way that the fee is actually charged is the percentage is 1.5% per year based on the daily average AUM. The fee is collected on a quarterly basis. That is how it works. I don't have the numbers ready immediately. Could you please drop your uh, email address and then we can share the workings with you? So far we have not had that. We have been allocating to uh, gold, silver, fixed income through from inception till now. There may be, for instance, if we go into a very low interest rate scenario and your precious metals theme plays out, maybe because our mandate gives us that flexibility to go 0 to 100 in any asset class, which means that at some point we may be 100% in equity. We could also be 100% in non-equity assets. But I think, see, the opportunities are plenty, right? We have to be creative and innovative with our investing style. And if we are a multi-asset PMS, we would like to stay true to that label. The minimum amount is SEBI's is regulated by SEBI. It is 50 lakhs today for any PMS, including Sphere. And if you're looking at a smaller investment ticket size, I think you could again reach out to us and we'll put you in touch with someone from the iThought ecosystem who could help you out. So our process works both ways, right? So one would be that we would encourage investors to participate continuously in the markets. If there is, say, a requirement for additional money at a specific account level where reviews happen, then our team will also reach out to you for additional participation.
Just to add to that also, in fact, from your side, we are accepting SIPs. So for Sphere, we can do SIPs also, where you can contribute monthly to your portfolio as well. Yeah,
Yes, monthly, sir. So we don't like to do this versus that comparison. We actually think that both work for investors depending on what they would like to achieve. I think solitary return expectation is set at around 15%. We try to operate in the 12 to 15% space. We are also looking at taking a slightly lower risk in terms of lower volatility and all of that. And like one of the key differentiating features in terms of portfolio is that Solitaire focuses on low debt companies. So typically banks would not be part of their investment framework, whereas in Sphere, if we look at that, we have a sizable allocation to banks. But financial services wise, I think there is a reasonable allocation in both portfolios. Um, and ideally, I think you can do both together if you have the capacity. If you are looking at just one PMS, then I think it's worth having a conversation with our team so that we can understand what would be the best product fit, because that is one step in the process of identifying what product an investor should choose, because based on your risk, your return, as well as your financial goals and certain other specific requirements, then we would be able to tell you which product suits you better. And of course, ultimately, the decision will still be yours. You can choose either what we recommend or what your preference is. No problem. We're
And
always happy to have conversations and address questions. Harshil, anything you wanted to
yeah,
say?
and in terms of all the products in our ecosystem, everything is a complement to each other. So we don't really see it as one single product. We always see it as a complement. So we always see it as Sphere with Solitaire. We always see it with Sphere with True Blue. So yeah, depending on the profile. So whatever your requirement is, when if you can be moderately aggressive, there is a good chance of Sphere plus Solitaire. If you're conservative, if you have certain goals that don't allow us to take that certain amount of extreme risk, but also we need to make sure that we need that push in terms of returns to meet that goal, then True Blue with Sphere really works, right? Somebody extremely aggressive, it's all it's all complementary, it's all basket oriented, right? So that's how we've made all our products, because each and every product is a complement to each other, where one product lacks, the other product covers up with their USP and their investing style.
This is a really good question. What would you suggest for a person with an investment corpus below 50 lakhs, say 10 lakhs? I think Harshil would actually be the best person to answer this, because he's been championing, along with Shamsa, this program that we are running called Milestones to Wealth, where we're helping people go from wherever they are in terms of savings to their first crore in savings. Harshil, you want to talk about Milestones to Wealth?
Yeah. See, the idea was that when it comes to PMS, 50 lakhs is, a big enough corpus for anybody to commit. And anybody would think whether you have 50 lakhs or they don't have 50 lakhs. But the point that we understood is that investors don't really need to take extremely high risk. They can just commit to any sort of corpus that they have that they're comfortable with, where we would take them through investing via mutual funds itself, for them to set a milestone over the course of time. So we've had investors setting milestones for 5 lakhs, we've had investors setting milestones for 10, 25, and 50. And we made sure that what suits somebody who's having a 25 lakh goal or a 50 lakh goal, what suits them, we would do best for them based on their appetite, and make sure to handhold them in every set of process, be it equity investing, be it their insurance, or be it having a financial plan, uh, where they have to meet a particular goal or they have a loan commitment. That's why we had started this program, where we wanted to handle investors to reach a particular target, to reach a particular goal, right? And it's a goal that you would be setting for yourself. So it's nothing that we would say that no, you need to for you to need FFLX, you need to do this. No. So it's all milestone driven, it's all goal oriented, and it's all based on what you said. But we would handhold you to make sure that in your entire journey of wealth creation and wealth building, it would be easy to walk on that path for you to go to the journey of 1 crore. So we've set a target that every investor who wants to save money in India should set a target saying, yes, 1 crore is a good enough target for me to meet. And we handhold them across the entire process, and it would take about 3 or 5 years, depending on where you start and depending on how you start. But the entire process is goal oriented and handholding, and make sure that every aspect of your wealth is sorted. So that's where milestones to really help you out. We interact with investors on a weekly basis, like how we are doing a webinar here. I do webinars for milestones regarding what they can do, regarding what we are doing on milestones. And Shamsa does a lot of videos on what we are doing on M2W as a program. If you are really interested, we can put in the number in the chat box at the end of the webinar, so that you can get in touch with that team, and we will be able to help you out really well.
The next question in terms of whether we consider other emerging markets, um, yes, we do. So for us, the world is our oyster, right? We are looking at global as a theme. If the value is in emerging markets, we will do that. If the value is in advanced economies, we'll do that. And I think today that product universe is just expanding. So a few years ago, like for an investor from India to invest outside, even through the PMS route or as a retail investor, the options were few and far between. Today, I think we have more on the table, and that's just expanding. So I feel what we can do in the future is definitely going to be wider and greater than what we are doing today. And to answer this question on M2W, uh, after you reach the 50 lakh milestone, I think that is up to the investor what they want to do. If they're comfortable with the mutual fund journey itself, they can continue in that path. If they want to move to the portfolio management service, then that option is also open to them. We don't force them to do one or the other. It's completely at the investor's discretion as to how they want to take that journey forward. That getting to 50 lakhs through the mutual fund route is something that we wanted to prove that you can do with a safe investment like mutual fund, because in general there's always this thought process that after I've made a certain level of wealth, I shouldn't be looking at simple products like mutual funds.
Yeah, right. And the whole point is more to do with treating mutual funds and treating uh, such financial assets as a savings vehicle, where you can make more than inflation, where you can make more than FD, and have that sort of mentality for discipline. The entire program is meant to discipline investors, to show them that yes, if you are walking on the right path, if you are having some sort of a direction, and you set yourself a target with discipline, you are able to meet it. And today on the platform itself, we are serving around 600 investors, and we are getting extremely positive feedback from them, and how where we have been able to help them to meet whatever goal is coming. And just because they have reached 50 lakhs or anything of what is required for SEBI, doesn't mean that they should move. We work with investors who are having an extremely long term goal, where those goals itself might take a long time for them to meet. So it's all goal oriented, but we leave it up to the investor, to tell them that we will give you the same experience or a much better experience when it comes to PMS. But the whole idea is to make sure mutual funds and such financial assets are being treated as financial assets. They're all savings vehicle. It's not something that you trade in and trade out, and we only work with serious investors.
Yes. And I think 1 crore is the dream target, right? For a lot of people, that first crore in savings seems like the biggest sort of hurdle. And if you're, say, at 5 or 10 lakhs of savings, that can seem quite far away. But it's possible to achieve your goals in a much shorter timeline with dedication, focus, and right product selection. And that is what we want to bring to the table.
And we are not just doing this for our investors outside. Internally also, I can tell you that for each individual here, our planners also are working with individuals here as employees who have set that target of 1 crore, where we are also able to help them out. So internally also, we are very serious about how an investor really needs to see a target, see a particular milestone, and what it takes for them to meet that particular milestone.
There is no age limit for any of our products. You can join either Solitaire or Sphere. That's up to you. The only thing being that I think Solitaire does have like an exit load within 3 years. Sphere does not. So depending on your flexibility or your requirements, I think uh, that is really your discretion. And I would really encourage you to leave your details or get in touch with us. Harshil, can you leave the contact slide so that we can do a one-on-one conversation to help you with the product fit? And do you think the US is trying to cap the 10-year yield at 5% and trying to inflate away the debt with interim hawkish commentary? If growth and momentum start to perform better than value contra, would you change your style? So I'll answer the second question first because see, style is something that is inherent, right? I cannot change who I am because the market is changing. If I'm going to do that, that's a big disservice to the investors who are coming in believing that we are following a particular process and framework. Um, so we will not, there will be periods where each style performs. Sometimes momentum is going to outperform contrarian investing. But eventually, what you see is contrarian investing performs only because of momentum, right? You need enough people to change their views, and then you'll see higher performance. So we are not keen on changing our style. We admit that maybe we are also human, maybe we might read something wrong, and we might have to rework a decision, but that doesn't mean we're changing the style altogether. In terms of where we think the US Treasury yield is, uh, see, I think your yield has already come down significantly since the Fed meeting because the commentary has not been hawkish. It's actually been dovish. Because if we just listen to how the chairman was talking through the whole year, it was always, we need price stability. Without price stability, the economy does not work for anyone. But the December meeting didn't have that one sentence which he has said every single time, right? So that itself kind of signaled that they're not so focused on price stability because that journey is happening on its own. But at the same time, they are aware that this last 1 mile from going from where they are to 2% could actually take longer or maybe a harder journey than coming from, say, 9-10% in 2022 to where we are today. Uh, so I don't think they are really trying to do anything. They've been quite sincere about shrinking the balance sheet. So the that has happened. So I think that's where we are today. You really don't know what is going to happen, how long it's going to take for inflation to come to 2%, whether uh, 3% is the new normal or not. All of these are questions that will get answered in 2024. We have to be a little patient and continuously be engaged in reading that situation.
And just to add to the style of investment, see, there has always been a narrative in the market for contrarian, and you are already seeing contra funds and value funds and all that. See, the point is, we don't go by that norm. We are not theoretically, there is no label that we see that just because we are value or just because we are contra we do this. The whole point is, when we say that we are contrarian or we follow value investing, is to give that message that no, we are doing things that are very rational, not irrational. Right? Rationality is what we want to do. If it makes sense for us to do, we would go out and do. If it does not make sense, then we will not do it. So whenever we are trying to, when we see businesses where we have to pay an extremely high multiple for very subpar business, we always think that no, we should wait and see, be on the sidelines, and then that's why it pushes us to buy businesses and to invest into areas where we find, yeah, these are businesses that cannot be replaced. These are businesses that have very good competitive advantages. And how much do you want to pay for it? If, little bit is what we pay as entry tax, and that is completely fine for us. So we don't have a particular label saying we are, just because we have value, we are only going to do this. Most of our investments that we are doing right now in Sphere, and what we had done before also, they were all value, but they turned out to be growth in a couple of years. So what is value now can change into growth later. So things keep changing. But what we mean by value and contra is, we want to take only rational decisions. We don't want to be irrational when it comes to making decisions for an investor.
Thank you, sir. I think we're all very grateful to be part of this ecosystem, and we just want to share that with other people as well, whatever we have here. That is coming out in our products as well as programs. Do we have any further questions? Thank you, everyone.
Thank you all. Thank you all for spending a good 1.5 hours with us. We hope to interact with you again further. We are having webinars on a weekly basis. In fact, even now in our ecosystem, there is a True Blue webinar that's going on. I think it has already started at 11. So do look it up on social media and immediately join in. We are having weekly webinars on various topics, on various styles. So follow us on social media, Twitter, YouTube. All our information is going to be out there. We want to be extremely transparent when it comes to data and what we think. So I hope it will be a very fruitful discussion also going forward. Thank you so much.
Thank you. I'll just quickly end the meeting for everyone. If you have anything else, you can get in touch with us on either through email or message. And we look forward to seeing you in our next webinar.